Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to another edition of our weekly podcast. Global equities continue to trend higher on region-specific developments. In the US, most equity benchmarks remain under pressure at the start of the week on concerns over rising inflationary pressures, but recovered later in the week amid a less hawkish than expected US Fed policy guidance, weak non-farm payrolls data, and rising unemployment. Asian equities continued to trend higher, led by Hong Kong, which rose about 6%, and China, which also rallied more than 4%, as investors continue to rotate into these markets amid still attractive valuations. Back home, Indian equities also posted modest gains. The Nifty index started the week on a positive note, but gave up gains later in the week on heavy selling in benchmark heavyweights amid cautious investor positioning ahead of the key US jobs data. Broader markets' performance was mixed over the past week, with the Nifty Midcap Index up 0.6%, while Nifty Small Cap Index was down 0.3% for the week. Among sectors, utilities and auto led the winners with gains of over 1.9% for the week, while IT and telecom led the losers with cuts of over 1.7% for the week. The Indian fixed income market had another good week, with Indian government bond yields falling across the curve, driven by a sharp decline in crude oil prices, strong investor demand at the RBI's weekly debt auction, and a sharp decline in US bond yields amid weaker non-farm payrolls, rising unemployment, and less hawkish US Fed policy guidance. The 10-year Indian government bond yield fell 4 basis points to close at 7.15%, while the 3 and 5-year Indian government bond yields fell by 4 basis points and 2 basis points respectively. The INR closed flat against the USD at 83.38 per dollar as the impact of lower US bond yields, weaker USD, and lower crude oil prices were negated by foreign investor outflows. Brent crude oil extended losses on Friday to post the steepest weekly decline in 3 months, down nearly 6% for the week, as investors weighed lower than expected US jobs data and the timing of interest rate cuts by the US Fed and its potential impact on economic growth and oil demand. Among the domestic macro updates, the first was on India's services PMI, which rose to 61.7 in April 2024 from a 61.2 recorded last month. It was the 33rd straight month of growth in services activity and the steepest pace in 3 months, driven by a further rise in new orders and improving capacity utilization. Export orders improved, with companies also noting a quicker rate of new orders when compared with factory orders, linked to a stronger demand from Africa, Asia, Australia, and the Americas, Europe, and Middle East. On prices, firms saw a slowdown in input cost inflation, while output charges rose at a softer rate. The second data was on India's manufacturing PMI, which eased modestly to 58.8 in April 2024, compared to 59.1 recorded in the previous month, and market forecasts of 59.5. This reading was the second fastest in over 3 years, supported by rising demand. Firms experienced a sharp upturn in new business intakes, with the pace of expansion being the strongest since 2021. New job creation, though, moderated but was still at the fastest pace since September of 2023. Meanwhile, cost pressures ticked higher, though staying below its long-run average. It pushed output charge inflation to a 3-month high. Finally, Indian manufacturers anticipated increase in output in the coming year, with business confidence rising in April, supported by expectations of sustained demand. At this point, I'll take a pause and thank you as always for listening. If you enjoyed the podcast, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.